What I thought I'd do this morning is give you some of the directions of travel, reasons and methods that we're using in Statoil to grow Statoil in what is a very volatile macro environment. To grow not only the footprint of our industrial activity, but also to grow the value and financial performance of the company. What I'd like to do is begin by making some comments on the macro environment, and this is a slide which I have borrowed from Ernst & Young in the last few days. This is a slide which is really a cartoon of macroeconomic progress and volatility measured by some stock market metrics. And what this slide shows is that all of us in this room involved in the management of these of the global energy system have really had the privilege but also the challenge of living through two extremely distinct macro systems. The first being one which started sort of mid-1980s, the global opening up, the increase in world trade, the fluctuating but steadily improving economic growth program, then interrupted by all the events we're very well aware of, perhaps from about the summer of 2007. I listened to Jean-Claude Trichet speak recently, the ECB past president, and he said that through 08-09, as they made unusual interventions in the monetary system, they really had no models whatsoever to understand the effect of the systems. So we are operating in what I think Shell rightly calls a period of volatile transition. I also put at the top there two other phrases which we in Statoil think describe the current situation very well. The first is the age of the unthinkable. What happened to BP post-Macondo and the rapidity of it was before the event unthinkable, for example. And another phrase there is G0. This is from Ian Bremmer, the president at Eurasia Group, who talks about the lack of alignment relative to the previous 20 years in geopolitical leadership and coherence. So we are living in a radically volatile world. And in Statoil, we started to recognize this a couple of years ago as we digested the events of 2008, 2009. And we took the view that we had to restructure our business process, our organizational structure, our balance sheets, our portfolio, our diversity and optionality, and also the strategic posture that we would take in the next 10 years. And you know, in the Western oil companies and Western stock markets, there's this phrase you hear quite a lot, which is shrink to grow. As one strategic posture towards this volatility. That is not our posture. Our intention is to grow, both industrially and financially, in order to contribute to the absolutely extraordinary common challenge we have with the societies in which we operate and which Jay articulated so coherently at the beginning of his presentation. So I'll say a few things about the growth of our financial performance through this volatility, and then I'm going to pick out four strategic themes that we in Statoil are asked about a lot. How do you increase growth in what some people think is a mature Norwegian shelf? How does a large state-based bureaucracy compete with the agility of independent companies in exploration? How do you make money in the US onshore when price is so under pressure, at least in the gas system? And how do you continue to grow through acquisitions in such a volatile environment? So firstly, to industrial strength. Again, for those of you who are not familiar with the debates in Western capital markets, in addition to shrink to grow, there's also a very popular discussion about value and volume. And this value-volume dilemma is posed as a either-or. We don't see it like that in Statoil. We see it as a both-and. You can grow your industrial footprint whilst also increasing your financial performance. Last year was in fact a record year for us, whether you look at it on an operating or reported basis, whether you look at it pre or post-tax. The pink blob there is basically the adjusted, i.e. repeatable earnings performance post-tax. And for those of you not familiar with the krona, that's about $10 billion of post-tax investment in what is a 72% marginal tax rate for our company. And in the first quarter of this year, we continued with similar momentum. And actually, some people not familiar with these figures say, well, this is very easy when you're at record oil prices. But actually, when you deconstruct this, what you find is that oil price year on year was up about 12% and 15% in gas price. But that's only 50% of the answer to this. What we've tried to do is to grow industrially. And quarter on quarter this year, last year, we grew our production, in fact, by 11%. And we're on record as saying that the international part of our business will grow from today, which is 662,000 barrels a day of equity production. We're going to grow that with the portfolio we've currently accessed towards 1.1 million. When I joined Statoil 10 years ago, we were producing 60,000 barrels a day, most of it non-operated, outside of Norway. This growth has not come at the expense of our balance sheet. If you look in the top right-hand corner, you can see that we've continued to provide shareholders with a growing cash flow through dividend. And at the top left, we've also continued steadily through this extraordinary, actually historic period of disruption in the macro markets. We've grown our organic capital expenditure. That does not include exploration, that does not include dividends, and it does not include acquisitions. We've grown from about $13 billion a year to about 17 this year. And if you look in the bottom left-hand corner, you can see that at the same time, the only thing we've been shrinking is our debt to capital ratio, which is down at about 13%, and on current forward prices will be about 10 or 11% by the end of the year. We've also got enough flexibility in this system, which is shown in the bottom right-hand corner, whether the oil price drops for a prolonged period to 80 or whether it maintains at around 110. We think we will continue to have good operational cash flow to cover our requirements. Nor has this growth come at the expense of running down the resource and reserve base. So last year, both in terms of SEC reported and also in terms of total resource defined in the grossest way, we managed to grow the reserve base as well. In fact, last year was the first year that we achieved in excess of 100% reserve replacement rate. It was 117%. What we particularly like about this is that 70% of those additions were liquids. Nor has the growth come on the basis of compromising our safety record. Through this downturn, we've continued to try to work on production efficiency and also HSE statistics. And I've given you there some spills and serious incident frequency factoids for you to digest. Let me come now to the base business, the heart of our business now and for at least the next decade, which is the Norwegian shelf. In summer 2010, the new executive at Statoil sat down and asked, what do our stakeholders think of our core business? And the answer was that many of them mistook it for a mature province in which the real financial and industrial challenge was to pedal harder in order to stand still. That is a very inappropriate way of looking at our core business. So since the summer of last year in our communications with stakeholders, we've tried to divide the business into three very distinct parts, all of which have very significant growth embedded in them. The first is up in the north, in the Barents area. This is not a mature area, this is a frontier exploration area. In the last 18 months, we've made two very significant discoveries, Skrugor and Horvis, opening up a whole new play. Today, my chief executive is in St. Petersburg talking to Rosneft and Gazprom about the opportunities MOUs you've seen us sign there recently. The Goliath ENI operated field will come on stream soon, and we will have the 22nd round in Norway. This is a frontier growth area. It's very exciting. There's nothing mature about it. If you then move into mid-Norway, the Norwegian Sea, I've set out on the slides, which you can examine at your leisure, some of the greenfield production projects that will come on stream to 2016. There's half a dozen of them there. By 2016, this will be net to Statoil greenfield investment, which will produce net to us about 225,000 barrels a day of new greenfield production. There's nothing mature about that. When you come to the most southerly area, this is the traditional area of the well-known giants, the Gullfaks and Statfjords. Now this has mature elements to it, and this is where we work particularly hard on IOR and tie-in. And these are not challenging projects in terms of unit cost. Actually, the IRRs on these tie-ins would make any venture capitalist and private equity capitalist very happy. These are very significant in terms of return, but in terms of absolute volumes, they're much smaller. But what is most important about this area is that it is a new frontier exploration area. This is where we found, together with our partners, Lundin and others, the new Johan Sverdrup field, a field which the Ministry of Petroleum and Energy in Norway thinks could have somewhere between 1 and 2.5 billion barrels of reasonably light oil in reasonably benign conditions. So this idea that the Norwegian shelf is mature and challenging and rather dull is very wrong indeed, and we've spent a lot of time trying to recontextualize that. Like Jay, I can't pass over a presentation without some seismic. But essentially, this is the beginning of the revitalization of the Norwegian shelf, not the end. And in each case, we have operating positions. In each case, we have 40 to 50% working interests. And in each case, we are going to do the best we can to try to bring these new fields, these new oil fields, on into production before 2020. Efficiency does remain a big issue, particularly in the south. And we've not released figures on this until this week, actually. But these are not our figures, these are third-party providers. But what I wanted to show you here is that most of our fields are in the first and second quartile of production efficiency, around 87.6 for the first quartile. And the pink blobs that I've put on there, that is not chronic inefficiency. That is where we've had specific incidents like the Gullfaks overpressure, like the Snorre riser degradation. And so we're working to bring those pink areas back into greater efficiency. Of course, production efficiency, as you all know, is not the only metric that you'll look at. You'll also be looking at closing down production to bring in some of these high return IOR projects and fast-track tie-ins that I've spoken of. I'd like to say a couple of words about exploration. We revamped the leadership and the structure, organizational structure and risk processes in our exploration department 2 years ago, and we've just started to see some of the results. Many of you will know that in the last 18 months we've had 7 high-impact discoveries. I've spoken of Sverdrup and Skrugor, also extensions to Peregrino heavy oil field offshore Brazil last year. But so far this year we've had 4 new discoveries, the Zafrani and most recently last week Lavani discoveries in Tanzania. This is dry gas, it's approaching about 10 TCF of recoverable. It's adjacent to some BG acreage. We think it's very competitive with what is going on in Mozambique. So can large companies and state-owned companies compete with the nimble independents? This is in the exploration arena. This is data from IHS and from Restart Energy to data providers. If you look at the far right, these were the results of our old exploration strategy. We're doing sort of middle of the road, finding volumes on a gross basis, but not all of those were developable and absent from the high impact finds. If you move to the far left, you can see that in the last 12 to 18 months, ourselves and ENI, together with Anadarko and a few others, have been in the sweet spots of the high impact discoveries. But if you look in the middle, if you look at value creation over, in addition to the volume, you find that because most of what we in Statoil have discovered is black oil and liquids, the value accretion we think is attractive. In New York Capital Markets Day last year, the head of our exploration department, Tim Dodson, announced that he thought that we had about 30 billion barrels of risked resources in our current exploration portfolio, of which he thought over the next 5 years or so we'd be able to drill out about 6 billion barrels. He said that at a time when the historic performance had only been about 200 million barrels. Last year, he drilled out about 1.1, and so far this year, with the recent Tanzania discoveries, we're running at about the same rate. To do this, we're spending about $3 billion a year on exploration expenditure. And we intend to continue to do that through this volatile period. We have spent, roughly speaking, about $10 billion in US onshore unconventional since, and we've made our first move in October 2008 at the height of the post-Lehman chaos by joining Chesapeake in their Marcellus formation. We often get asked by shareholders, what are the prospects for this given the shale gas pricing? Well, the first answer to that is most of this isn't gas. The gas is in the northern Marcellus, which is actually the sweet spot of the Marcellus. In the southern Marcellus, it's gas and gas liquids. In the Eagle Ford, we're in the gas liquids window. And in the Bakken, which we bought last year, that is black oil. And this diversification is absolutely deliberate. The second thing is we're joint operator with Talisman in the Eagle Ford and sole operator in the Bakken, and working hard to join Chesapeake in operating parts of the Marcellus. And this flexibility of ramp up, ramp back, ramp down is part of our new strategy to ensure that we've got more control over our capex in the event of unforeseen events. It's mostly to do with the profitability endemic in the rocks, the relative stability of the US political system compared to many other places, but it's also to do with having a capex profile that doesn't get stuck if we go through another 208. When we went through 208 last time, about 90% of our capex was stuck for the coming 18 months. Today, that is 65%, and we have more discretion over that 65%. I'll start to make some closing remarks now. Not only are we growing industrially, but we're also continuing to grow inorganically. Last year, we bought Hess out of our Snøhvit Northern LNG project, and we also spent about $5 billion investing in the North Dakota black oil shale. We are doing portfolio adjustments. We are divesting. We divested some of our Norwegian shelf to Centrica. We sold our gas pipelines in Norway. This week, we've just received proceeds from the sale of our residual interests in our fuel and retail systems. And a couple of years ago, we brought in new partners into our Brazilian and Canadian operations. This is not about shrink to grow. This is about redeploying capital from parts of our business where we think growth has been defined into the new areas of growth, whether that be in Skrugard or whether that be in the Bakken. This is a redeploy to grow strategy, not a shrink to grow strategy. In the center of the slide there, you see some comments on what we might see in North America. Trading, for those of you in the business, you know that trading is endemic to the business model, actually. It's not a special thing. It's part of the organic process. But what you will see us in Statoil do is move into the land grab, the earlier phase in the business cycle. Having now spent a lot of money being operator, we now feel competent to begin to look at that phase. And finally, on this item, we don't, with the balance sheet that we've got in our recent industrial performance, we don't see the current disruptions in the world only as threats. We also see this as periods of great opportunity for value creation. The final remarks I'd like to make are really harmonious with some of the things you were saying, Jay. We can't shrink to grow because our main purpose to the societies in which we're embedded is to contribute to that extraordinary growth in energy demand. So we have to grow to contribute. But we in Statoil, coming from a Scandinavian and part state and part private capital, hybrid if you like, Mark Moody Stewart used a different phrase last year, but being a hybrid and stakeholder, optimizing around a variety of stakeholders, we feel that the definition of the role of private capital in this industry has gone is really outgrown this traditional phase of shareholder value. It's more complex than that. A lot of academics and consultants are beginning to discuss what might replace that phrase. Shared value is one that's been discussed by McKinsey, Dominic Barton, and Michael Porter in the Harvard Business Review. It's a new vocabulary, but I think it's probably the vocabulary of the future, and we in Statoil want to contribute to that future. Thank you for your attention.